Hi, everybody. I'm Dr. R. Meena Kumari. I welcome you all for the course Economic Analysis for Business. Let's start with the introduction of economics. Let's see how this term economics has an implication in India. In India, economics term can be found in the olden texts of Vedas. We do have a Veda called Atharva Ved, which includes many concepts, similar concepts of economics in it. Followed by Atharva Ved, we have another very famous sage called Chanakya. He belongs to Maurya Empire, is an advisor to the Maurya king, and he wrote a book called Arthashastra with the help of other sages, which can be called as a treatise on statecraft, which includes the economic policies and military strategies in it. Coming to the economics given by the Western counterparts, economics formerly was called as political economy, and this political economy term was first ever given by Professor Adam Smith in his book, An Enquiry into the Nature and Causes of the Wealth of Nation, which was published in 1776. And Adam Smith was the first such economist who discussed about economics in this book. This book focuses the study of economics as on wealth. He considered acquisition of wealth as the main objective of human activity. And economic is the study of how wealth is produced and consumed. That's why Adam Smith is called as father of economics. This slide shows the different important school of thoughts. In economics, basically we have four school of thought. One is wealth-centered, second is welfare-centered, scarcity-centered, growth-centered. Wealth-centered economical thought was given by Adam Smith, J.B. Say, and J.S. Mill, whereas welfare-centered thought was given by Marshalls and Pigo. Then comes scarcity-centered, ideas, which was given predominantly by Professor Lionel Robinson. And growth-centered thought or growth-centered concepts were given by Samuelson and Keynes after the Great Depression, 1930. Let's see the definitions, all the four definitions of economic thought. Let's first start with the wealth definition given by Adam Smith. Economics as a science which inquired into the nature and cause of wealth of nation. So the entire focus was on wealth and how the wealth should be acquired and distributed and how it should be employed. That was the focus in Adam Smith's definition. and that's one of the pioneer definitions of economics. Welfare definition here I have given as Alfred Marshall's definition. We can see that Marshall has said economics is a study of mankind in the ordinary business of life. It examines that part of individual and social action which is most closely connected with the attainment and with the use of the material requisites of well being. Here we can see that the economics was focused from wealth to mankind, and it has been understood that wealth is important only to acquire the material requisites of well being. So there was a shift from wealth, focusing from wealth to welfare in Alfred Marshall era. Scarcity definition given by Lionel Robbins. Economics is a science which studies human behavior as a relationship between ends and scarce means, which have alternative uses. Here, Professor Robbins says that economics is nothing but a study of human behavior, and we have scarce means and unlimited ends, or and these scarce means or these resources, whatever we have, has got an alternative uses. So it is very important for the human being to decide on the most optimum utilization of the resources. Coming to growth definition, which was given by Professor Samuelson. Economics is the study of how people and society end up choosing, with or without the use of money, to employ scarce productive resources that could have alternative uses to various commodities and distribute them for consumption, new or in future, among various persons and groups in this society. It analyzed the cost and benefits of improving patterns of resource allocation. Here, I would like to say that growth concepts or growth era came after the Great Depression. Till Great Depression, whatever the economists have discussed or told was totally changed in growth era. Here, individual units are not taken into consideration. Aggregates were taken into consideration because aggregate impact was the Great Depression. When Great Depression experienced by the world, it is the aggregate action. So Samuelson have focused on how to use money, how to employ these scarce productive resources that could have an alternate uses, and how to distribute the things for the consumption. And it also talk about cost benefit for improving the patterns of resource allocation. So this is like, combining all the aspects of microeconomics in the growth definition. The growth arise more focusing at macroeconomical concepts. Let's see how economic word is derived from. It is derived from two Greek words. One is okios, means a house. Nemen means to manage. Together it means managing a household. So economics is like indicating or referring to managing a household, managing a country, managing a business of one company, managing a business of a sector, like that. And that's how the term economics implies. Let's see the basic concepts of economics. Now, the very first concept is supply and demand. Now, supply demand, all of us know that very, very important terms in economics. And these two are very vital for fixing a price. Most of the theories of microeconomics are based on demand and supply. Not only micro, even macro also depends on demand and supply. These are very important for price determination, uh, for production, for understanding the demand. And that's why these are very important concepts of economics. The second important concept of economic is scarcity. Scarcity, as we all know that we have already seen that Professor Robbins have given the enormous focus on scarcity because the resources are scarce. We don't have abundant resources. So whatever resources we have, we need to do the best utilization of it or optimum utilization of it. Then only the maximum satisfaction or maximum production can be reached. So that was a scarcity term is very important because it is in economics only we consider resources are scarce. So with the limited resources, how am I going to get the maximum benefit? That is the focus of most of the theories here. Coming to the opportunity cost. Now, what is opportunity cost? Opportunity cost is like a trade-off market. It is like an exchange policy. Now, if let's take an example here. I have a plot of land. Now, I can cultivate paddy in the same plot and also I can cultivate vegetables in the same plot of land. Now, I have cultivated paddy. So I have foregone the income of vegetable and I have opted for paddy is because paddy is a better trade-off than the vegetable. So in opportunity cost, it is very much understood that the trade-off is such that whatever we are not opting for, like in case of a land, if there are two options, one is paddy cultivation and another one is vegetable cultivation. And if I'm not opting for vegetable cultivation, it means paddy cultivation is a bit beneficial than in comparison to the vegetable cultivation. Another aspect in economics is time value of money. Time value of money, very, very important. We all know the value of money depreciate as time passes. And it differ from time to time based on the different factors. The utility that is derived from every money a consumer spends is based on time. If I have 10,000 today has more value than a 10,000 kept for a date maybe 10 years later. So the value of the money reduces. Purchasing power. Another fundamental economic concept is purchasing power of consumer. Because purchasing power is one of the most important concept or important aspect which influences the demand. Now, what do you mean by purchasing power? Purchasing power means the disposable income in a consumer's hand. The amount what a person can spend on a good or a service. That's called as purchasing power. And this is very important is because this influences demand. In economics, demand doesn't mean that how many people are asking for a product. It is actually mean that how many people are having the purchasing power to buy that particular commodity. Now let's see the fundamental principles of economics. These principles, more or less, have taken from the basic concepts. Let's see, first is your opportunity cost principle. As I said, the total reward for the factor in that occupation is greater or at least no less than the factor opportunity cost. What does it mean? As, as I've already discussed, opportunity cost means trade off. Instead of this, I am opting for something else, and that is more beneficial than this. That is what is opportunity cost. And this principle states that a decision to accept an employment for any factor of production is profitable if the total reward for the factor in that occupation is greater or at least no less than the factor's opportunity cost. That means any factor of production, for example, labor. Now, one labor is going for construction work, another labor is going, another option is you can go for another design work or something like that. Now, if a person is going for design work, that means he is able to acquire more money than the construction work. That's why this particular person or a labor is opting for design work. Second concept is discounting and compounding principles. This is again based on the value of money. All of us know that compounding principle. Compounding principle fetches more money. All today, the SIP accounts, all these are based on compounding principle. And all of us know that um, how much income we can make if we are carefully do investments in mutual fund. Discounting is about how the money value depreciate. For example, due to the inflation. Um, Here I would like to say that when a decision involves money receipts or payments over a period of time, all the value transaction must be valued at a common period to be meaningful for that decision analysis. It's very important that one should consider the time factor in terms of payments or receipts. Marginal or incremental principle. Marginal or incremental principle. Marginal means additional unit, and which implies or the additional unit added in the total number of unit gives an additional revenue. Sometimes additional factor gives an additional revenue, and that additional revenue indicates the entry of the additional marginal factor. For example, we have 100 labor and they were producing 1,000 units of an X product. Now we have employed 101 labor and they are producing 1,010 units of an X product. Now this 10 extra unit produced is because of the 101th factor or 101th labor joined in the group of 100. So that is what a marginal concept, which is very taken as very important in economics. Equimarginal principle, which means how rationally a consumer behaves, who always likes to equate the marginal returns with marginal cost. Time perspective principle in economics. Economics, all theories are based on short run and long run. So in short run, as a short period, maybe 1 year, and long run is a long period, maybe above 1 year to 10 years. Now, what is the basic difference in this short run and long run? Short run is a period where there are, if you look at cost, there is fixed cost and variable cost. But the same cost in long run, all costs are variable because everything can be changed due to the time period. So these are the basic principles of economics: opportunity cost principle, discounting and compounding principle, marginal or incremental principle, equimarginal principle, time perspective principle. Let's see the nature of economics. Economics is a science and an arts. We can say economics is science because any systematized body of knowledge which studies the relationship between cause and effect, it can be called as science. And it should be able to forecast. And economics is an art because economics, when we deal with demand, it is an art to induce the demand. It's an art to increase the demand. Let's see in the general market concept how demand is increased. Demand is increased due to various type of advertisement. And advertisement is an art to persuade a consumer. Economic is a normative or and positive science. Economics is termed as positive or pure science because it analyzes cause and effect relationship between two variables. And it says what it is. But it also can be called as normative science because it involves a value judgment. It is prescriptive in nature and describe what should be. So for example, we can see a lot of less income or competition in employment is maybe the causes population. So economics as a positive science, it says that we see a lot of unemployment problem is because of the population. So it states what it is. But economics can also prescribe the solution for unemployment. That's why it can be called as normative. Scope of economics. Scope of economics is divided in two categories, that is micro and macro. Microeconomics and macroeconomics. So let's say microeconomics. Microeconomics deals with individual unit, relates to factor and product pricing based on assumption of other things remaining constant, based on laissez-faire policy, that is non-governmental interference, use of marginal principle, analysis of market structure, and it does not deal with aggregates. So micro means study of one individual, study of one firm, study of one factory, study of one sector. Then it is called as microeconomics. Macroeconomics opposite to the microeconomics, which studies aggregates. It talks about or discusses about general price level, general equilibrium. It is very useful in policy formulation, gives a overall picture of the economy. So micro means study of individual units, macro means study of aggregates. Let's see the deeper scope of micro and macro. In microeconomics deals with the demand and supply. That means consumer demand and consumer supply, which is a firm's demand or firm supply, which is very important from individual point of view. Production, how a firm should produce, how much production should be made, what should be the cost, and all these aspects. Consumption, consumption is how much will be consumed by the consumers. economic welfare. But it's coming to macroeconomics, national income, general price level, distribution, employment, which are all aggregate concept. When I say the income of one individual influencing demand and supply, national income is just opposite. It is the income of aggregates, income of all the individual, income of all the firms, all the industries. So macroeconomic deals with aggregate, micro deals with individual unit. Corporate decision, corporate decision making. So there are some very vital, important decisions taken by the corporates. Pricing decision, determining the price of goods and services based on its cost, demand, and competition. Production decisions, choosing what to produce, how much to produce, and which technology to use. Investment decisions are allocating funds to projects, R&D, and expansion to ensure a long-term growth. Cost control is another very important corporate decision making, which includes managing labor, raw material, and capital efficiently to reduce production cost. Market strategy states that decisions related to advertising, branding, distribution, and product differentiation. CSR, that is corporate social responsibility, which is one of the most popular concept today in brand building and creating goodwill in the society. Balancing profit with ethical and environmental responsibilities is the concept of CSR. So these were the corporate decision makings on different aspects. Now let's see the economic system. What is an economic system? Economic system is a means by which societies or governments organize and distribute available resources, services, and goods across a geographical region or country. Now, this system also very important to regulate the factor of production. What is a factor of production? Factor of productions are land, labor, capital, and the resources or the organization. This economic system influences on the different institution and decision making process and also plays a vital role in economic policy formulation. There are three type of economic systems. Let me tell you, capitalist economy or economic system, socialist economic system, mixed economic system, which can be called as capitalist economy, socialist economy, mixed economy. Let's start with capitalist economy. Capitalist economy, it's very much power oriented and with the profit motive. This kind of economies are generally focuses on production, low cost and high profit making businesses. For example, the countries like US, Australia, Canada can be called as capitalist economy. Now, what are the features of capitalist economies? Profit motive. So first thing is profit motive, which induces the individual owner to work and produce. Private property rights. The capital goods like land, factories, machineries, etc., are under private ownership, and the owners have the right to employ them in the manner they like. Next is consumer sovereignty. In this system, consumers are free to make a choice as to how they want to spend their income. Next, freedom of enterprise. Every individual is free to choose and involve in an economic activity. What does it mean is every individual can take their own decision to enter into any market or can produce any product. Next is competition. Competition exists among various sellers to sell the product and services to consumer. This is you can see a lot in the capitalist economy. Income inequality. In capitalist economy, you can also find income inequality, disparity of income between haves and have-nots can be noticed because here the public's or the government interference will be lesser, the profit motive aspect will be much higher, which which automatically results in income inequality. Next is socialist economy. Now, socialist economies today, like you have China, Vietnam, Hungary. Now, what is the socialist economy is like? Socialist economy acknowledges the three uh, inquiries in the different way. In socialist society, the government determines what products are to be manufactured in accordance with the requirement of the society. And the government role is very, very important in a socialist economy. Everything you can say that government decides. The features of socialist economy are state-owned productive resources. In a socialist economy, there is a collective ownership of productive resources such as land, mines, factories, banks, mills, etc. Most of the important resources are owned by the government. Economic planning. In socialism, planning plays a very vital role. It is the planning done by the government for the acquisition of resources, for implementation of system, for production, or distribution of income, everything. Next is social welfare. In socialist economy, the most important motive or the most important aspect in the socialist economy is social welfare. This implies that it seeks to maximize the interest and the welfare of the society and the people in the country. Classless society, that means no inequality. Since it is taken care by the government, it is government ensures that there is less gap between haves and have-nots. And the income can be distributed in all the factors of production more or less evenly. Elimination of competition. So wherever is required, government can eliminate the competition. And this happens because government is the sole owner of all the productive resources. So it can act as a monopoly to the produce of all kinds. The last one is mixed economy. Mixed economy is actually have got the characters of both capitalist and socialist economy. In mixed economy, you can see private sector as well as public sector. Mixed economy also have got economic planning. For example of mixed economies, like the best example will be India. So here what you can see private sector, availability of private sector, as well as the availability of the um, public sector. So both go hand in hand in the development of the country. Existence of planning, economic planning. So all of us know that In India, we do 5-year plan so that the country can grow better. The plans for which sector has to be, boosted by the government, which sector needs a tax or how much tax has to be implemented. All these aspects of economic planning is done in mixed economy also. Government control over private sector. So in mixed economy, it is seen that though private sector can act independently, but the government control will be there over it. In some cases, like country like ours, where we have done liberalization to some extent, which is but again under the government control. Reduction of income inequalities. So since we have both private as well as the public sector, it is important uh, that we can see less income uh, or economic inequalities between the haves and the have-nots. And this is because there is an existence of public sector, there's an existence of private sector, so there will be profit motive. But at the same time, public sector indicates at the economic growth or the welfare of the people. Government protection of labor. So protection of labor indicates that nobody uh, will exploit them, and the laborers are given due importance since the existence of government rules and regulation. Consumer sovereignty is protected through different laws in the mixed economy. Next is forecasting. What do you mean by forecasting or demand forecasting? When it comes to economics, we generally forecast the demand. But forecasting as a term means predicting, refers to making decision or prediction based on the future economic conditions. Why do we need this? We need this is for to solve the basic important questions of economics. Those are like what to produce, how to produce, and when to produce. So to solve these basic economic questions, forecasting helps a lot, that how much to produce. Forecasting is very important aspect for any business. Without a right prediction, the company will not know that how much of the product or the service is required in coming time. This involves analysis of past and present data using various economic models, indicators to estimate key economic variables like GDP, inflation, unemployment, and more. So, in everywhere, forecasting can be used. It can be used for both private and public sector. There are many methods of forecasting. Let's see the quantitative and qualitative methods. Quantitative methods are which are very calculative in nature, um, whereas qualitative method goes with opinion of the different sector of people. It's generally opinion polling method also, you can say. First one is in qualitative techniques, consumer survey method. Now, what is consumer survey method? If we want to know that how many consumers are ready to buy a new product in a particular segment. So that is by conducting a survey, we can understand or we can analyze or we can predict that how much demand is possible for this product. Consumer survey can be done with complete enumeration survey where you will cover all the consumers. And next is sample survey. Sample survey is in consumer survey, you can also do the sample survey. That is only selecting the samples. So basically, consumer survey methods is conducting a survey for a product or to understand the market for any such reasons. Next is Salesforce opinion method. We all know that Salesforce is such a important group of people who interacts with the consumer directly. Hence, they can or they can tell the company what exactly the consumers are thinking, or what exactly the perception of the product for a consumer. And they know better because consumers generally tell all grievances to the Salesforce. So Salesforce opinion can can make a company benefit for forecasting. Next is expert opinion method. This method is very suitable in such situation where the change is not traceable. For example, the technological changes. What kind of a technology? Now, all of us know that AI is dominating the market. So, how could be the future trend? So, such thing is very difficult to take survey. Even survey may not give a very right answer. Therefore, expert opinion method is the best method, because expert can have the very the data related to the new concept, and they may be in a position to tell the right information, or their information can be more suitable for forecasting. This technique is also called as Delphi technique. Next, let us see the quantitative techniques of forecasting. Among quantitative techniques, first let me start with trend projection. Trend projection method. It is based on assumption that the future trend are the continuation of the past, and therefore historical data can be used to predict the future. So if we study 10 years data, our past data, we will know that how the consumers have reacted or acted if we are studying the consumer data of the 10 years. Then we know, or we can predict how the consumer will behave in case of a new product or in case of any situation. Next is this is your trend projection. Trend projection has many, economical analysis like time series analysis, uh, trend line observation method. So like that, you have least square method, smoothing method. You have many other methods under trend projection method. Next is economic indicator method. Now, what is this economic indicator? In this method, sales is forecasted by keeping any economic indicator as base. For example, now we want to know that what could be the future demand of building material. Now, to know this demand of building material, we can look at the the number of approvals for construction. Similarly, another example, demand of petrol can be understood with the number of registration for vehicles, and the demand for fertilizer with the agricultural income. Coming to the econometrics method. Now, econometrics methods are all those statistical methods which are used for forecasting demand. For example, correlation analysis, regression analysis, um, ARIMA method. All these can be called as econometric methods. The forecasting, let me be more honest that there are many statistical method. Most of the statistical method can help us in understanding the demand of a product. Now let's see the role of market and the government in an economy. Role of government first. Regulation and legal framework. Role of government, regulation and legal framework is very important role because enforcement of property rights, preventing monopolies, protecting consumer from exploitation, all this comes under regulations and legal framework which helps in regulating all these aspects. Provision of public goods provides goods and services that market may not supply efficiently, ensuring the accessibility and availability of goods and services to the citizens. Redistribution of income and wealth. Now, we all know that in mixed economy, what happens? The government have always a control over the private sector. So, due to the government interference, we can see many policies coming up for the redistribution of income and wealth. For example, in India, like taxation system, where we tax the high income group higher and low income group lower. This is one of the instrument of redistribution of income. Economic stabilization is another aspect of role of the government, which plays a very vital role in the maintaining the growth of the country, maintaining the different industries, preventing economic fluctuations like recessions or reaching high prosperity like that, promoting economic growth and development. So government also plays a very vital role in promoting economic growth and development through their economic policies and the decisions which develop sometime industries, sometime welfare activities, all these things. Correcting market failures by regulating the externalities and sustainable use of resources, the market failures can be reduced. Global trade and foreign policy. With global trade, the government can always may improve its may improve its income, may improve its industrial growth. So the global trade and foreign policy are very vital for every country. Let's see the role of market. Role of market is first is price determination. So any market is where you can see the price determination for the product. So role of market first is price determination. Second is efficient resource allocation. It is the market which fixes its price and due to which the resources or the factors of production can be allocated in a more efficiently. Coordination of economic activities. The another important role of market is coordinating the economic activities. Um, while using like input output model, if I say, how are we using the inputs more effectively with the proper technological base, and then we get a good output. So like that, the entire economic activities are coordinated well, providing incentives. So when when the product is good or when the product is taken very properly to the market, it gets more incentive in terms of sales, promoting innovation and growth. Since the market need is always identified, and this need identification boosts the innovation for new product and growth of a company. Distributions of goods and services. The goods and services can be properly distributed through the market system. Role in global trade. Market plays a vital role in global trade. All of us know that. Whether it is a domestic market, whether it is a global market, it has its own important role for selling the product or generating revenue. Thank you. With this, we are ending the first unit. Thank you.